In this video, we're going to talk about the creation of money in the banking system. Suppose Megan deposited $1,000 into a checking account at Bank A. The required reserve ratio, or RRR, is at 20%. Given that the RRR is 20%, Bank A has to keep 20% of the $1,000 deposit, or $200, as reserves. Bank A, therefore, can make loans up to $800, which is $1,000 minus $200. Below is Bank A's balance sheet. Bank A has both assets in the form of reserves and loans, $200 of reserves and $800 in loans, and liabilities in the form of deposits, or $1,000 worth of deposits. Now let's say Bank A makes a loan of $800 to Brian. The $800 is deposited into Brian's checking account with Bank B. Given the RRR, or required reserve ratio, of 20%, Bank B has to keep a $160 reserve, or 20% of $800, and can make loans up to $640. Below is Bank B's balance sheet. Bank B has assets in the form of reserves and loans, $160 of reserves and $640 of loans. And Bank B also has liabilities in the form of deposits, in which it has $800 worth of deposits. Now let's say Bank B makes a loan of $640 to Alex. The $640 is then deposited into Alex's checking account with Bank C. Given the RRR, or required reserve ratio, of 20%, Bank C has to keep a $128 reserve, which is 20% of $640, and can make loans up to $512. Below is Bank C's balance sheet. Bank C has assets in the form of reserves, which is $128, and loans, $512, and liabilities in the form of deposits, which is $640 worth of deposits. If these depositing and lending continue, the total amount deposit at the end is going to be $5,000, which is $1,000 plus $800 plus $640, so on and so forth. And the total amount of loans created is going to be $4,000, which is $800 plus $640 plus $512, and so on. In conclusion, with the process of depositing and lending, banks can create money. In this case, banks create an additional $4,000 into the economy from an initial deposit of $1,000. In addition, banks create $4,000 in loans.
Thank you for watching. Please like, share, and subscribe.